Hi, I'm Evan Bethards.
I'm Gary Alpert.
So today we thought we would run through some of the key provisions in the new tax bill that was passed last month. We've had a lot of clients asking us about, how their individual tax situation is going to be impacted. So we thought we'd give you a few key topics that we find could be relevant to your situation. Few of those items are the extension in the of the Tax Cuts and Jobs Act tax brackets. The estate tax exemption was also extended. There were increased standard deductions, as well as an increase to the state and local tax deduction cap. And then there were also some adjustments to charitable giving deductions that we'll talk about as well. So, Gary, can you take it away with the state and local tax deduction?
Sure. So a lot of people abbreviate this with SALT, SALT, but that's state and local tax deduction. And think of that as the combination of your property taxes plus any state taxes that you pay on your work income or the like. And what happened previously is there was a limit of $10,000, and that limit was increased to $40,000, which is huge. It's an extra $30,000 of deduction for those who meet that threshold. And the only limitation is that there's a phase out starting at a modified adjusted gross income of 500,000 for joint filers. So this is a huge difference and a huge opportunity for folks to get an extra tax benefit. And then there are folks in that $500,000 range, 500,000 to even as high as over 600,000, where there may be opportunities for them to take deductions, for them to bring their income lower and phase themselves back into that deduction. So some good planning opportunities there.
So you mentioned some planning opportunities. Can you name maybe a couple of those that could be just an easy strategy to implement?
Yeah, absolutely. So for example, if your income is above the phase out, you can increase your pre-tax retirement contributions if you're not at the max yet. You could increase or institute health savings account contributions, which are a pre-tax deduction. And even business owners, there may be some things they can do with their business income that would lower that a little bit. So suddenly you're in a phase out range of the SALT deduction, and you could phase yourself back in, which would create some hugely powerful deductions.
Awesome. So there's definitely some planning opportunities there, especially if you are within that threshold. So it's definitely good to keep an eye on what your income is looking like for the year. Like I mentioned, there was also an increase in the standard deduction for single filers, head of household, and married filing jointly. It's not a massive increase, but it is enough to kind of keep up with inflation, like we've seen the past several years. So make sure that you're just aware of that increase when you're working on your taxes for 2025. Um, Another deduction that was on top of the standard deduction that we saw was a temporary senior deduction. So if you're over 65 years old, for the next 3 or so years until 2025, individuals will get an additional $6,000 of a deduction. So if you're married filing jointly, and if you're both over 65 years old, that's an additional $12,000 on top of the standard deduction, which can be very powerful. However, there is also a phase out, much like Gary was speaking about with the SALT cap. If your modified adjusted gross income is over 150,000, if you're married filing jointly, or 75,000 for single filers, that $6,000 deduction will slowly be reduced until zero, and there are certain caps on the top end of that as well. Um, Gary, are there a couple of planning items that we could work around this new provision?
Yeah, absolutely. So we've done a lot of planning around this and have had conversations with several folks about it. So joint filers can get up to $12,000 of this bonus deduction if they're both over the age of 65. And then similar to the SALT deduction, if your income is a little too high, for example, if your modified adjusted gross income is 160 or 170, and you have the opportunity for pre-tax retirement contributions, that could be an option. If you're retired, you can even change the portfolio mix from an income standpoint and maybe move more money to tax-free income as a lot of people right now have their portfolios creating a lot of taxable income. Health savings account, once again, is another option. So there are ways to help ensure you stay within that range. And then it's basically just an additional $12,000 deduction if you can fit within that adjusted gross income range. One last thing, Evan's going to talk about this a little bit more, but there's also, for anybody 70 and a half or older, is the potential to take qualified charitable distributions, which is basically, if you're charitably inclined, is to make charitable contributions from your IRA account, which actually would reduce the amount of your required distribution subject to tax. That would be actually another way to bring you into that phase out range, or I should say below the phase out range as well.
Right. And then we found that folks that are well within that that phase out range, there even begs the question of, are Roth conversions appropriate? Are those powerful enough? Considering you've got an extra deduction, so there could be some possible conversion opportunities there too that we've been speaking about with clients already. So,
yeah. And one other thing I'll mention, Evan, is there's a window. I look at it as a window for anybody that's delaying their Social Security, really between 65 and 70 years old, where a lot of people have high levels of pre-tax assets, where you might actually have the potential to convert some of those pre-tax assets to Roth, or even spend them down and use these extra, we call them senior deductions, I guess, to your benefit. Just a lot of planning opportunities there for anybody 65 years of age or older.
yeah, so there is a lot there, and our conversations with clients have been very eye-opening, especially when it comes to planning opportunities for this year. So, Gary, do you mind segueing onto the estate tax exemption increase?
Yeah, absolutely. So there's always been concern that the estate tax exemption, if nothing were done, would revert back to the levels pre the TCJA bill. And so that we were looking at possibly an estate tax exemption of $5.5 million per person. It's now been brought up to $15 million per person. So look at the estate tax exemption just in a high level summary standpoint as the amount your estate can be worth before you're subject to any estate taxes. So 15 million is a high number. And then if you have a married couple, each member of the couple has that $15 million exemption. So the combination could be very powerful. And this is going to last for a few years.
Thank you. And then for the sake of efficiency, I'll go back and touch on what Gary mentioned about qualified charitable distributions. So like he mentioned there, if you're 70 and a half or older, you have the ability to make charitable contributions directly from your retirement plan, your IRA, and it's considered a non-taxable distribution. So if we're looking for ways to bring down your income, that's a potential opportunity because it essentially allows you to either take your RMD or distribute from your IRA completely tax-free, as long as it's going to a charity of your choice. And that could be hugely powerful, and it's good to offset tax burdens, and just a way to give to the things and the folks that you care about in a more tax efficient manner. And especially if you're taking an RMD and you're already charitable and you don't necessarily need your RMD, we find that it's a great opportunity to just pivot some of those pre-tax funds in a charitable manner. So we can talk about that more in person if any of that applies to you all. Gary, was there anything else you wanted to touch on before we gave it a send off?
Yeah, absolutely. So just a closing remark. So as part of our financial planning process, we ask for a copy of our client's tax return. And then we have software that analyzes the return, and we look for opportunities. We want to make sure, first of all, the return looks in good order, that everything is correct. But there's a lot of numbers we can play around with as a pro forma inside of the return to say, what if this? What if that? And we've found that to be hugely beneficial to the client. So whenever we provide them any advice, we are pretty comfortable with what the exact tax ramification would be, or at least close to it. So we think that's really helpful for folks, and we don't replace anybody's accountants. We're not accountants, but we feel like we can help with the tax planning throughout the year to be an excellent supplement to your accountants and an individual, hopefully, that will help them out as well as. So anyway, thank you very much for your time, and we look forward to speaking with you soon.
Absolutely. Thank you so much.